On the very first trading day of 2021, just after Brexit took full effect, roughly €6 billion of share trading vanished from London overnight and reappeared in Amsterdam, Paris, and Frankfurt. Within weeks, Amsterdam had quietly overtaken London as Europe's largest share trading centre. So here is the trillion-pound question this video answers: does the UK's financial sector still depend on the European Union? And if it does, how damaging and how rational is that dependence? Financial and related professional services are no small matter for Britain. The sector contributes well over £200 billion to the economy each year and roughly 12% of total economic output, employing more than 2 million people. So when we ask whether the City of London leans on Europe, we are really asking about the engine room of the UK economy and whether Brexit pulled a critical lever. To understand the dependence, you have to understand how London got here. For decades the city was not just Britain's financial capital but Europe's. Before Brexit, the UK enjoyed something called passporting. A bank or asset manager licensed in London could sell its services freely across all 27 member states without seeking separate permissions. That single right made London the natural headquarters for global banks wanting access to the European market. American and Asian firms set up in London precisely because it was a gateway to 500 million European consumers. The result was a concentration of activity that was genuinely European in scope. London cleared the bulk of euro-denominated derivatives, hosted the deepest capital markets on the continent, and dominated foreign exchange. That interdependence was mutually beneficial, but it also meant a large share of the city's business flowed to and from the EU, leaving Britain exposed when the political relationship changed. When the UK left the single market on the 31st of December 2020, passporting ended abruptly. The trade and cooperation agreement that governs the new relationship is enormous, but it says almost nothing about financial services. Banking, insurance, and asset management were effectively left out of the deal. Overnight, UK firms lost their automatic right to serve EU clients. To keep trading, many had to build or expand subsidiaries inside the bloc, in Dublin, Luxembourg, Frankfurt, Paris, and Amsterdam. According to tracking by professional services firms, around 7,500 finance jobs have shifted from the UK to the EU since the 2016 referendum. More strikingly, banks and asset managers have moved well over $1 trillion in assets out of Britain and into the European Union, roughly a tenth of the total held by the affected firms. That is the concrete cost of the dependence being severed. So if passporting is gone, what replaced it? The answer is a far weaker mechanism called equivalence. Equivalence is the EU unilaterally deciding that the UK's rules are good enough to allow limited access in specific areas. The crucial word is unilateral. Brussels can grant it, and Brussels can withdraw it, typically with only 30 days' notice. That makes it a fragile foundation for a multi-trillion-pound industry. Remarkably, in the years since Brexit, the EU has granted the UK equivalence in only one significant area. There is no broad recognition for banking or for most market activities. By contrast, the EU has handed full equivalence to dozens of other countries in various sectors. The message to the city has been deliberate: access is conditional, temporary, and politically controlled. For an industry that craves stability and long-term certainty, that is a genuinely uncomfortable position. Nowhere is the dependence more visible than in derivatives clearing, and here the dependence actually runs both ways. London's clearing houses, especially LCH, process the overwhelming majority of euro-denominated interest rate swaps, a market worth hundreds of trillions in notional value. EU companies rely on London to hedge their risks. Brussels views this as a strategic vulnerability, depending on infrastructure it cannot directly regulate. So it has repeatedly tried to force this business onto the continent. The one area where the EU did grant equivalence was precisely this clearing. In a significant recent move, on the 30th of January 2025 the European Commission extended that clearing equivalence, now running until the 30th of June 2028. That extension matters because the previous permission was due to expire in June 2025, which could have caused serious disruption. It bought time, but it did not settle the long-term question. Now for the crucial nuance, because the headlines can mislead. Yes, jobs and assets moved, and yes, share trading migrated. But the predicted exodus of hundreds of thousands of jobs never materialized. Estimates of 7,000 to 10,000 relocations are far smaller than the worst forecasts. London remains the world's leading center for foreign exchange and a top global hub for international banking, insurance, and asset management. Critically, much of the city's business is not European at all. The United States is the UK's single largest financial services trading partner, and global capital flows to London for reasons that have nothing to do with Brussels, the English language, common law, time zone, talent, and deep liquidity. So while the EU dependence is real in specific segments, it is far from total. London's strength has always been its global reach, not merely its proximity to Europe. So how justified is the anxiety about EU dependence? The honest answer is that it is partly rational and partly overstated. It is rational because equivalence is fragile, because the EU has every incentive to repatriate lucrative business, and because a sudden withdrawal of clearing access could cause real instability. Relying on a neighbor that can revoke access with a month's notice is a genuine strategic weakness. But it is overstated because the EU also depends on London, and forcing business onto the continent is expensive and slow. Brussels has discovered that you cannot simply legislate a financial center into existence. Both sides recognized this in May 2023, when the UK and EU signed a Memorandum of Understanding establishing a forum for ongoing regulatory cooperation. It is not market access, but it signals a pragmatic acceptance that complete separation serves no one. So, does UK finance depend on the EU? The verdict is yes, but selectively, and the dependence is mutual rather than one-sided. In areas like cross-border banking access and derivatives clearing, the relationship still matters enormously, and the fragility of equivalence is a legitimate concern that keeps regulators awake at night. Yet the apocalyptic predictions failed to arrive. London lost ground in specific niches like share trading, but it retained its crown as a genuinely global financial center serving America, Asia, and the world, not just Europe. The smartest takeaway is this: Britain's financial future will not be decided by whether it depends on the EU, but by how well it manages that interdependence while building stronger ties beyond the continent. The city did not collapse after Brexit, but nor did it walk away unscathed. The real story is one of careful, ongoing adjustment.